Today we'll be taking a question on from performance management, Ican performance management, November 2023. November 2023, question 4. Although I've taken a question on throughput accounting before, we are going to take this one based on requests. So we'll read the question, then the solution will be profiled as easy way as possible for your understanding. Thank you.
PK Limited manufactures two models of heavy-duty cooking rack suitable for use in restaurant kitchens and similar commercial environments. Both models use the same types of raw material and machine hour. No inventories ahead. The sales budget for the next year is as follows. Sales units: Model A 300,000, Model B 140,000. Selling prices: Model A 1,000 naira, Model B 1,400. The following additional information is provided. Cost data. All figures assumed to be correct. Fixed production overheads attributable to the manufacture of the two models amount to 40,500,000. Each model is completed in the machinery department. The production rate per hour in the department is Model A 12.5 units, Model B 10 units. Availability of machine hours is limited to 30,000 hours. Required: A. Using marginal costing principles, calculate the mix units of each model, which will maximize net profit and indicate the value of the net profit. B. Calculate the throughput accounting ratio for each of the two models and briefly discuss when it is worth producing a product where throughput accounting principles are in operation. Your answer should assume that the variable overhead cost amounting to 24 million naira incurred as a result of the choosing product mix in Part A is fixed in the short term. C. Using throughput accounting principles, advise management of the quantities of each model that should be manufactured, which will maximize profits, and prepare a projection of the net profits that will be earned by PK Limited next year. D. Explain two aspects in which the concept of contribution in throughput accounting differs from its use in marginal costing.
Okay, so the A part of the equation, as we read, is using marginal costing principles, calculate the mix in units of each model, which will maximize net profit and indicate the value of the net profit. So what they're asking is using marginal costing. Marginal costing technique. And we'll use the marginal costing technique to determine the product mix, the optimum product mix, and also to determine the profit that will come as a result of that product mix. First, we are going to find out, if we are solving this, we'll find out if they are constrained in one way or the other. Now, according to the question, they say availability of machine hours is limited to 30,000 hours. Machine hour is limited to 30,000 hours. So machine hours is limited to 30,000 hours. We'll find out if, which is the first thing we are going to do, if machine hours is a limiting factor or is a bottleneck based on the product you have here. We have model A and we have model B. According to the question, we have model A and we equally have model B. So let's find out if the hours that we require in producing these two models will exceed this. If it exceeds this, then machine hours is a limiting factor or is a bottleneck, which is still the same thing. The quantity that is mentioned here, they say they have 300,000 units for model A, 300,000 units for model A, which is what is required. Model B, They say they have 140,000 units. 140,000 units for model B. Now, in the question, it was clearly provided that model A, you can clearly see we have 12.5 units per hour. That's what they produce. Then model B, 10 units per hour. So I will divide this for model A. Model A, I have 300,000 units divided by 12.5 units per hour, which is provided in the equation. That will give us 24,000 hours. So this 24,000 hours. Then for model B, I have 140,000 units, which is desired to be produced over 10 units per hour. That will give us 14,000 hours. So 14,000 hours. If you add up these two, it gives us 38,000 hours. You can clearly see that the hours that will be required in producing model A and model B exceeds the limit of 30,000 hours. So that is the first thing we are going to do. So what it means is that machine hour is a limiting factor and machine hour is a bottleneck. So we'll have to find out. Since we have verified that machine hour is a limiting factor, the next thing we are going to do is to calculate the contribution per unit and the contribution per machine hour. So we'll calculate the contribution per unit. Contribution per unit. Now, if you remember in marginal costing, if you have watched the first video on Throughput accounting that we posted, marginal costing considers all variable costs, takes cognizance of every variable cost. So I'll be having sales less every variable cost provided in the equation to give us our contribution. So we'll proceed to that. I'll just say model A. I'll say model A, and model B. For model A and model B, I have sales price. The selling price as given in the equation is model A 1,000 and model B 1,004. So model A 1,000 and model B 1,400. That is what is provided as the selling price. Now less the variable cost. For the variable cost, we have material cost and variable production cost. Material cost, variable production cost. So material cost, and variable production cost. So material cost, as we have in model A, is 400. Then the variable production cost is 100. So I will less them 400, and the variable production cost is 100. The same goes to model B. Model B, I have material cost to be 500 and variable production cost to be 300. So this is 500 and 300. So 1,000 minus 400 minus 100 will give us 500. 1,004 less 500 gives us 900. Less 300 gives us 600. So those values you have gotten because our contribution per unit. So this is a contribution per unit. So contribution per unit, model A 500, model B 600. Since you have gotten the contribution per unit, we need to get the contribution per machine hour. Now the machine hour per unit needs to be gotten as well. So let's get the machine hour per unit. Machine hour per unit. Now, clearly they told us in the question that we produce 12.5 units per hour. So to get the machine hour per unit for A, machine hour per unit for A is 1 over 12.5. 1 over 12.5 hours. Then machine hour per unit for B is still 1 over 10 hours. So 1 over 12.5 hours will give us 0.08 hours. So 0.08 hours. Then 1 over 10 hours for model B gives us 0.10 hours. 0.10 hours. So we have gotten the machine hour per unit. Model A 0.08 hours. Model B 0.10 hours. Then we need to get the contribution per machine hour. Contribution per machine hour will be to divide our contribution per unit by the machine hour per unit. So contribution per machine hour. Contribution per machine hour. I have 500, which is the contribution here, divided by the machine hour per unit, which is 0.08. The same thing goes here. I have 600 divided by 0.10 hours. So that will help to give us our contribution per machine hour. I will need to wipe this to continue. Contribution per machine hour. So the contribution per machine hour, I have 500 over 0.08 hours, which will give us 6,250 hours. 6,250 hours. Then for model B, 600 over 0.10 hours will give us 6,000. Not in hours. 6,000. So we'll have the contribution per machine hour is 6,250 for model A. Then we'll have 6,000 for model B. Then the next will be to rank them based on what we are saying. We are ranking them based on the contribution per machine hour. Ranking. If we are ranking them, obviously this comes first. This is the higher, while this is the second. So based on this, we are going to decide what our product mix will be. Then from there we can proceed to determine the profit based on those product mix. Now, based on our ranking, it means that, okay, let's determine product mix. That will be based on the ranking we have here. What it means is, for the first product, the one we ranked first, we'll produce all of it. We'll produce every one of it because it still falls within our constraints, our limit, our hours that we are constrained to. So the product that I said that we need for A is 300,000. Model A, they will need 300,000 units. 300,000 units. So 300,000 units times the hours that is required to produce a unit here, which you can see are the machine hour per unit. So we have one, we say produce all of model A. Model A will have 300,000 units. 300,000 units times the machine hour per unit is 0.08 hours. So if we multiply 300,000 units times 0.08 hours, we are going to be getting 24,000 hours. So it takes us 24,000 hours to produce all of model A. Then the remaining that we have, we are going to allocate to model B. Now, what is the balance? If I'm using 24,000 hours to produce model A, then what will be left? Remember, we have 30,000. 30,000 hours as what is available. So 30,000 hours minus the 24,000 hours we have used in producing model A, we'll be left with 6,000 hours. Now this 6,000 hours is what we are going to use in the production of model B. Now to produce model B, you will take note of the 0.10 hours, which is the machine hour per unit. So what we are going to do is to divide the 6,000 hours that is available so that we'll know how many units that will go for model B. So for model B, what we'll do is the 6,000 hours that is available divided by 0.10 hours, which is the machine hour per unit. That should give us the units that we are going to produce for model B. So 6,000 hours divided by 0.10 will give us 60,000 units. So with this, we have gotten the product mix. What it means is for model A, we'll be producing 300,000 units. Then for model B, 60,000 units. Model A, 300,000 units. Model B, 60,000 units. So that is the product mix. Next, we are going to proceed in computation of the net profit. Computation of net profit. Computation of net profit. I won't wipe here because I want to use this contribution per unit in determining the net profit. So instead, I'll wipe this side. So computation of net profit. So net profit, that is under the A, which is the marginal costing technique. For the net profit, we will consider the unit you are producing, multiply them by the contribution per unit, then we will less the fixed cost that is provided in the equation. For model A, let's say our contributions. Model A, they will have model B. Model A, we say we are producing 300,000 units. 300,000 units times the contribution per unit for model A is 500. 300,000 multiplied by 500 will give us 150,000. 150,000. For model B, we say we are producing 60,000 units. 60,000 units multiplied by 600, which is the contribution per unit. 60,000 units times 600 will give us 36,000. 36. This is in millions. Let me just think, I will just write it in full. I have 300,000 times, okay, let me see. 300,000 times 500. 150 million. I think it's better in that way. Here is 150 million. Then here I'm having 36 million. That is 60,000 times 600. We'll have 36 million. So this, the addition of the two will give us total contribution. Total contribution, we have 150 million, which is from model A, and 36 million, which is from model B. So 150 plus 36. That will give us 150 million, sorry. 150 million plus 36 million will give us 186 million. 186 million. So this is the total contribution. From the 186 million, I will less the fixed cost. I will less the fixed cost. The fixed cost, as provided in the equation, they told us is 40,500,000. So 40,500,000, I will less that 40,500,000. If I less the 40,500,000, and I have what we call the net profit. So 186 million minus 40,500,000 will give us 145,500,000. 145,500,000. That is the net profit using the marginal costing approach. So we have answered the A part of the question. We will proceed to profile solution to the B part of the question. The B part says, calculate the throughput accounting ratio for each of the two models and briefly discuss when it is worth producing a product where throughput accounting principles are in operation. Your answer should assume that the variable overhead cost amounting to 24 million incurred as a result of the chosen product mix in part A is fixed in the short term. What are they talking about? Throughput accounting doesn't consider every variable cost as variable. Some are seen as fixed. The only one considered as variable is the direct material cost. That is what is seen as variable under throughput accounting. So some of the ones we considered as variable in marginal costing will no longer be variable. What do they mean? You can see here, we did variable production cost. We took it as variable. It's no longer going to be variable. So it will now become a fixed cost. So I will wipe this and we'll proceed to compute for the B. So they want us to compute for the throughput accounting ratio. To compute for the throughput accounting ratio, recall what we said, that the throughput will consider just the material cost or the direct material cost. What we'll need to do first is to calculate the return per factory hour. We'll compute the return per factory hour. After that, we'll proceed to compute. After computing the return per factory hour, we'll proceed to compute the cost per factory hour. Then later, we'll divide them to get the throughput accounting ratio. So throughput accounting ratio, which is B, throughput accounting ratio. Throughput accounting ratio is simply the return per factory hour over cost per factory hour. That's a throughput accounting ratio equal to return per factory hour over costs per factory hour. So return per factory hour over cost per factory hour. That will give us our throughput accounting ratio. So we'll proceed with the return per factory hour. Return per factory hour. In computing our return per factory hour, we are going to consider getting the throughput per unit. After getting our throughput per unit, we will get we already have our machine hours per unit. So throughput per unit first. Let's get this model A. Then I have model B. We have the selling price, which is given as 1,000 and 1,004 according to our equation, which we have already used. 1,000 and 1,004. Then less the material costs. Less material costs. Material costs, we have 400 for model A and 500 for model B. So 400, so I will less 400 here. 400, then I will less 500 here. If I less this, I will be having 600. Then here, I'll be having 900. Now, this value that I have is what we call the throughput per unit. This is the throughput per unit. throughput per unit. If you recall when we did the marginal costing, the contribution per unit, we did less material and less the production. But here we are doing only less material. So this gives us the throughput per unit. Now the throughput per unit that we have gotten, we are going to divide it by the machine hours per unit. We have already computed the machine hours per unit where we solved the A. That will help to give us the return per factory hour. So we have machine hours per unit as already computed. I have 0.08 hours. Here I have 0.10 hours. That is the machine hours per unit. Then we'll go to the return per factory hour. Now return per factory hour. Return per factory hour. Return per factory hour is simply dividing the 600, which is the throughput per unit, over 0.08 hours, which is the machine hours per unit. So here the same thing, 900 divided by 0.10 hours. So return per factory hour for model A, 600 divided by 0.08. 600 divided by 0.08 will give us 7,500. So that gives us 7,500. Then 900 divided by 0.10 will give us 9,000 hours. So 9,000, not hours. So 9,000, we've gotten the return per factory hour, which is the component here, return per factory hour. So we are going to move to get the cost per factory hour. To get the cost per factory hour, we have other costs, that other fixed cost which was given in the equation. So let me get the cost per factory hour. To get the cost per factory hour, we already have a cost that is provided in the equation. They said our fixed cost is 40,500,000. Fixed cost. Fixed cost. Fixed cost is 40,500,000. Now recall that there are some costs we initially considered as variable when computing for marginal, which is now fixed under throughput. So we are going to bring them in. Now what are they? You can see that we had variable production for model A is 100, then for model B is 300. So we produce 300,000 units based on what we computed before. We produce 300,000 units of model A. So I will multiply it by that 100, which is that variable production cost. It's no longer variable production cost. It's now coming in as a fixed cost. So I will bring in other variable costs now considered fixed. So other variable costs now fixed. Other variable costs now fixed. So model A, model B. Model A will produce 300,000 units. 300,000 units times what is the per unit value we are giving here? 100 for model A. So I'll multiply this by 100. So 300,000 times 100. 300,000 times 100 will give me 30 million. So 30 million. I'll do same for model B. Model B will produce 60,000 units based on those product mix we talked about. So what is the cost? Under model B, we have for variable production cost, which is now fixed. We have 300. So 60,000 times 300. So 60,000 times 300 will give us 18 million. 18 million. That gives us 18 million. I will add all of those costs together. That will give us the total factory cost. So total factory cost. Total factory cost is the addition of the fixed cost which was given in equation 40,500,000, then addition of this other cost that were initially variable but now considered fixed. So 40,500,000 plus 30 million plus 18 million will give us the total factory cost. The addition of all of that will give us 88,500,000. So that will give us 88,500,000. That is the total factory cost. But what I need is my cost per factory hour. Cost per factory hour. How many units? How many hours did they say is available? They say 30,000 hours is what is available according to the equation. We check in the last information before the requirement. They say availability of machine hours is limited to 30,000 hours. So I will divide this by 30,000 hours to get the cost per factory hour. Cost per factory hour. So cost per factory hour is now cost per factory hour. Cost per factory hour is now 88,500,000 divided by the 30,000 hours that they say is available. So 88,500,000 divided by 30,000 hours will give us 2,950. 2,950. This 2,950 is now the cost per factory hour. Now recall our formula. We say the throughput accounting ratio is simply the return per factory hour over cost per factory hour. So return per factory hour over cost per factory hour. Return per factory hour over cost per factory hour. We have gotten all the components we need to compute. So we'll compute for model A. Model A. The return per factory hour of model A, as we have computed, is 7,500. So 7,500 divided by the cost per factory hour, which is 2,950. Then I will do that also for model B. Model B, I have 9,000 as computed divided by 2,950. So for model A, 7,500 divided by 2,950 will give us 2.54. 2.54. Then model B, 9,000 divided by 2,950 will give us 3.05. This is the throughput accounting ratio. Now, considering the two, both products are actually very viable because a throughput accounting ratio that is less than 1 is what is termed as what? Unviable. Throughput accounting ratio that is less than 1 is unviable because the return, for it to be less than 1, the return per factory hour should be less than the cost per factory hour if it's going to be less than 1. But as long as your return per factory hour is higher than the cost per factory hour, it is viable. You can see this is 2.54, very much higher than 1. This is 3.505, which is also very much higher than 1. But considering the two of them, the model B gives a higher return per factory hour. So that should be considered more. So I'm going to proceed to compute the C part of the equation. Compute the C part of the equation. The C part of the equation says, using throughput accounting principles, using throughput accounting principles, using throughput accounting principles, advise management of the quantities of each model that should be manufactured, which will maximize profit, and prepare a projection of the net profit that would be earned by PK Limited next year. Now, the same thing we did in the A, but this time using the principle of throughput. That is just the difference, using the principle of throughput. Now, we'll have to re-rank this. If you observe the other time we did ranking, so here we have to rank again. We have to rank this, but this time not ranking them according to contribution, but according to whatever value we get of the throughput. So we are going to rank this based on the throughput per factory hours. We have already computed the throughput per factory hour. So ranking based on throughput per factory hour. I will rank them based on throughput per factory hour. Model A has a throughput per factory hour. Model A, Model B. Model A throughput per factory hour is 7,500. We have computed that before. Then model B is 9,000. You can see it changes the ranking. In ranking, this one comes first, while this will be considered later. So model B will be considered first this time. We will consider model B first this time around. Then next, we are going to determine the new optimal production mix. We will determine the new production mix, optimal production mix, based on this our ranking. Optimal production mix. For the optimal production mix, we are going to produce all of model B. We will produce all of model B. Model B, they say the units that is required is 140,000 units. 140,000 units. You can say all of model B based on the ranking. And what they need is 140,000 units. Now we'll find out how many hours it will take us to produce that 140,000 units. We already have the hourly, the hours it takes us to produce each item, which we have already done before. The hours per unit, which model B gave us 0.10 hours. So I will multiply this 140,000 units. 140,000 units now is that 0.10 hours. To know how many hours it will take us to produce this. That gives us 14,000 hours. 14,000 hours. Now the remaining hours will be allocated to model A. What is the remaining hours? What is available in total is 30,000 hours. And we have used 14,000 hours in producing model B. So 30,000 minus 40,000 will give us 16,000 hours. Now these 16,000 hours will be allocated in the production of model A. Now how many units will these 16,000 hours give to us? The same way we did in the other computation, we will divide the 16,000 hours by the hourly, the hours it takes us to produce 1 unit. So for model A, the unit will be, model A, the unit will be 16,000 hours. 16,000 hours over 0.08 hours. That should give us 16,000 hours times 0 divided by 0.08 hours will give us 200,000 units. 200,000 units. Now, the optimal production mix based on the throughput factory per hour that we have done here based on this ranking. We have 140,000 units for model B and 200,000 units for model A. 140,000 units for model B and 200,000 units for model A. You have gotten the optimal production mix. Then, once you have gotten that optimal production mix, we are going to proceed to the computation of the profit. We will proceed to computation of profit. Computation of profit. To compute the profit, we are going to be using total throughput. If you observe when we did marginal costing, we did total contribution before we start lessing the cost. So we will consider total throughput. So for the total throughput, I have model A, I equally have model B. Model A, 200,000 units was produced. So 200,000 units times the value we have already gotten, which is the throughput per unit. Throughput per unit for model A is 600. So 200,000 units. 200,000 units times 600. 200,000 units times 600. 200,000 units times 600 will give us 120 million. So 120 million. I'll do same for model B. Model B, the units is 140,000 units. So I will check that by the throughput per unit, which is 900. Throughput per unit is 900 for model B. So 140,000 times 900 is going to give us 126 million. 126 million. So the addition of both of them, 120 million plus 126 million, the total throughput will be 246 million. Total throughput. Total throughput is 246 million. Since we've gotten the total throughput, we are going to less the cost. Record that initially we used only the fixed cost that was produced, that was given to us in the equation. The fixed cost was 40,500,000. But now, there are some other variable costs that were initially variable that we have now termed as fixed. So we have calculated the total fixed cost. We've done that before. If you refer back, we got 88,500,000. When we bring in other variable costs that were initially variable and make them fixed, I will add them with the already existing fixed cost of 40,500,000. What we got was 88,500,000. So that is the cost you are going to less here. So we will less fixed cost. 88,500,000. So if I less fixed cost of 88,500,000, I'll be having a net profit of 157,500,000. Net profit of 157,500,000. So that will give us a net profit. The net profit of 157,500,000. That is the net profit using the throughput method. So we have provided a solution to the C part of the equation. Lastly, the D part of the equation, they said, explain two aspects in which the concept of contribution in throughput accounting differs from its use in marginal costing. What I simply said is the difference. What makes them different? Okay, first of all, first thing that makes them different is based on the definition of variable cost. In marginal costing, contribution is simply the selling price less all variable costs. Selling price less all variable costs. While in throughput accounting, contribution, which is also known as throughput, is selling price less only direct material cost. So that is one way that they are different. The second way that they are different is this: the treatment of inventory valuation. For marginal costing, the cost of material is only expensed from sales when the product is sold. When that product is sold, that is the only time they expense it. Material costs in closing inventory are carried forward as an asset. That is the treatment under marginal costing. But under throughput accounting, the cost of all materials purchased in the period is deducted from sales revenue of that period, regardless of whether the finished goods have been sold or are still in inventory. So they don't care whether they have sold it or not, it is what? Deducted. So this discourages inventory building because it reduces the reported throughput. So this is the second way that makes it different from marginal costing. So this is what have been asked in the question. I hope you find the video useful in your preparation for the forthcoming examinations. Thank you very much for your time.